Money printing is coming back. And the scary part is not that the United States is printing money again. The scary part is that your country will print even more. Every time new money is created, the people who get it first benefit. And the people who get it last quietly pay the price. If you don't receive that money early, your savings don't disappear, they slowly lose purchasing power. You can work harder, you can earn more, and still feel poorer every year. This is not bad luck. This is how modern financial systems are designed to work. And once you understand this cycle, inflation, rate cuts, and money printing suddenly start to make sense. Let's start with something simple: the size of the economy. In 2008, the total GDP of the United States was about $14 trillion. Today, it is close to $28 trillion. That means the economy has doubled in size. A bigger economy needs more money moving through it. More companies, more transactions, more loans, more debt. So when people say, why does a growing economy keep printing money? The answer is simple. Because a larger system cannot run on the same amount of money. Printing money is not a policy choice. It is a structural requirement. The real question is not whether money will be printed. It is where that money goes first, and how long it takes before wages catch up. That time gap is where most people quietly lose purchasing power. A common argument sounds like this: the dollar didn't collapse. It's still strong. And technically, that's true. $1 can still be exchanged for other currencies. Global trade still runs on the dollar. But currency strength does not protect daily life. Inflation doesn't destroy money overnight. It slowly changes what money can buy. Prices rise first. Assets rise first. Wages adjust last, if they adjust at all. So even when the dollar looks stable on a chart, your cost of living tells a different story. This is why people feel confused. Nothing looks broken, yet everything feels more expensive. That confusion is not accidental. It is the normal outcome of monetary expansion. When discussing money printing, most people focus on absolute numbers. But that's the wrong comparison. What actually matters is money creation relative to GDP. When you look at it this way, the picture changes completely. Japan has printed money, equal to more than 100% of its GDP. Europe has also expanded aggressively. The United States is not the most extreme case. It is simply the reference point. Every time the US prints money, other economies are forced to respond. If they don't, their currencies strengthen, exports suffer, and growth slows. So global money printing is not optional. It is a chain reaction. Now let's talk about interest rates. The Federal Reserve cuts rates. Today, the policy rate is around 3.75%. On paper, that sounds supportive. But reality looks very different. Credit card interest rates are above 21%. Mortgage rates remain around 6 to 7%. This tells us something important. Cheap money exists, but it doesn't reach ordinary people. It stays inside the financial system first. Rate cuts are not designed to make borrowing cheap for households. They are designed to prevent financial stress from spreading. That's why rate cuts often fail to improve daily life, and sometimes make inequality worse. Employment data looks confusing at first glance. More jobs are being created. At the same time, unemployment rises to the highest level in years. This is not a contradiction. Many people lose stable full-time jobs and replace them with multiple part-time jobs. 2 jobs, 3 jobs, sometimes more. Employment increases on paper, but income stability disappears. Banks understand this very clearly. When income quality drops, default risk rises. That's why banks tighten lending standards even when interest rates fall. Banks don't react to headlines. They react to balance sheets. When risk increases, banks protect themselves. They lend less. They charge more. High interest rates are not punishment. They are warnings. Banks see rising defaults, unstable income, and weak reserves. So even when central banks cut rates, consumer borrowing stays expensive. This is why monetary policy feels disconnected from everyday experience. Rate cuts stabilize banks first. Households come later, if at all. In 2020, banks faced a liquidity crisis. To prevent collapse, the Federal Reserve created a final safety tool called the Standing Repo Facility, or SRF. Think of it as a 24-hour emergency pawnshop. Banks can exchange government bonds for cash instantly. For years, almost no one used it. Using it signals distress. Recently, usage has started to rise. That tells us something important. Rate cuts are no longer enough. When liquidity dries up, the only solution left is balance sheet expansion. Money printing. Just like 2008, Just like 2020, understanding this cycle early means you don't need to panic. You just need to be prepared. If this helped you understand the system, like the video and subscribe to the channel.